Welcome all. My name is Ria, and I'm your host for the session. Giving you a background about QuantInsti. QuantInsti was founded by a group of traders, coders, and analysts who love to teach and share their experience about financial markets. We have been training individuals and corporate organizations across 75 plus countries across the globe. We started with just 5 participants in the first batch, and today our batch consists of around 100 to 140 participants on an average. Having said that, there are many keen seekers who would like to get a feel of how a typical lecture in EPAT is conducted. Our very own Mr. Prodipta Ghosh has graciously agreed to take this session and help us all. I would like to give you a brief about Prodipta. Prodipta leads the fintech products and platform development and QuantInsti. He is a seasoned quant, and prior to joining QuantInsti, he spent more than a decade in the banking industry in various roles across trading, structuring desk for Deutsche Bank in Mumbai and London, and as a corporate banker with Standard Chartered Bank. Before that, Prodipta worked as a scientist in India's defense R&D organization, DRDO. He is a graduate with BE in Mechanical Engineering from Jadavpur University and has postgraduate degree in management from IIM, Lucknow. Without taking much of your time, I would like to invite Prodipta to take over the session. Over to you, Prodipta.
Thanks, Ria. That was a really nice introduction. And thanks everyone who has joined us here. Thank you very much for your time. Uh, Today, we will have a somewhat structured look at developing and optimizing a trading strategy in the typical quant way. So without much ado, we'll go ahead with the presentation. In case you cannot hear me or you have questions, please type it away. Before we start with the main theme, just a few definitions so that we are all on the same page. All these terminologies like systematic trading, quantitative trading, algorithmic trading, high frequency trading, so they're often are misunderstood even sometimes by the practitioners, and they are in fact quite different things. Systematic trading is a way of trading where you make your decisions based on rules. It doesn't matter how the rules are formed, whether totally arbitrary or through solid research, as long as your trading is based on rules, it's systematic trading. Quantitative trading is a subset of systematic trading where your rules are based on quantitative analysis. When you talk about algo trading, in that case, we talk about a different aspect. Here, we talk not about the trading decisions, but about the executions of trade. If you are executing trade through pre-programmed trading instructions, i.e. a computer program, it is constitute algorithmic trading. And high-frequency trading is a subset of algorithmic trading, where you send orders at a very fast rate. That is one of the characteristics. And the second most prominent characteristic is your order to trade ratio is typically very high. That means a number of the orders that you send do not get ever executed. So now that you have some idea about these basic terms, quite small and interesting, hopefully, sneak peek into what quantitative trading really is vis-a-vis discretionary trading. I'm sure all of you, those of you who have traded, you are familiar with discretionary trading. That is trading manually, deciding what to trade manually vis-a-vis quantitative trading. So here is a small question for you. So we have two cases. Asset manager A is a discretionary manager and follow 10 stocks diligently. whereas asset manager B is a systematic trader. And of course, he has the computer power behind her, so she can track around 500 stocks at the same time. Now, the investors really do not care whether you trade discretionary or you trade systematic. All they care about outperformance and what is the confidence level they have on your outperformance, meaning whether your outperformance is luck or not. The first question, what is the hit ratio for A to achieve an outperformance in at least 50% of the stocks with at least 95% probability? Hit ratio in the sense, how many times A has to be correct in his prediction to achieve this benchmark. And this question 2 is the same, but for B. Now, if you make some somewhat simplifying assumptions, then we can answer this question like as in the next slide. So if you are not familiar with the maths shown here, not a problem. You can always reach out to me or someone from QuantInsti later. Would be happy to explain. But what transpires is that simply by the fact that B was tracking more number of stocks, more number of assets, and having an opportunity to trade more number of assets, she has a built-in edge over A. To beat A, B has to be only around 55, 56% of times correct. Whereas to achieve the benchmark, A has to be around 78 to 80% correct. And you see that in trading, where the randomness is inherent, is an integral part of the market, being 80% of the time correct is quite a lot. It's a large ask. So now you see where the appeal of systematic trading is. And before you take this wrong conception that systematic trading, I'm trying to say, is better than discretionary trading, no. Both has its own place, and both can simultaneously live together. The age of systematic trading is, as we've just seen, the large number of stocks we can track, whereas the age of a discretionary trader, by the fact that they're tracking much fewer number of stocks, they have a much deeper proprietary insights, which are not possible if you are tracking too many, right? And as a matter of fact, the typical returns for a discretionary trader is losing in many stocks, but then catching those one or two multi-baggers, the typical value investors. On the other hand, the systematic trading, if done correctly, it results in a much smaller annual return, but a much steadier one. Of course, you are coming from different backgrounds, whether physics or chemistry or anything else, and every field has its own fundamental law. So trading is, of course, not an exception. So there is a fundamental law in trading as well, or rather known as the fundamental law of investment management, which is, as you see in the slide, it says that the information ratio is directly proportional to the information coefficient multiplied by the square root of number of bits multiplied by the transfer coefficient. And if you're not very familiar with this terminologies, it's absolutely fine. We'll share the material probably later, so you can have a greater look at it. At this point in time, all you have to understand is that the performance of an investment manager over the benchmark is directly proportional to his hit ratio, that is his inherent skill. Also, is proportional to the square root of number of bits it takes. And as you have seen, why B is excelling is because the number of bits for B is much larger. So hopefully this gives you some perspective about systematic and quantitative trading. Before we move on to developing a strategy and optimizing it, just a quick sneak peek into the strategy spectrum, as I'd like to call it. So what you see here, on the x-axis, we have different sources of your profit and loss in your strategy. Some say sources, some say factors. Those are just terminologies. On the y-axis is a different way of trading. So you have the technical trader, the fundamental trader, the quant. So as you can see that a source of risk or returns can be captured by different traders, different styles in different manners. So mean reversion trade becomes pair trading or statistical arbitrage for quants. For technical traders, it becomes a retracement or a swing trades. And on the other hand, for a fundamental, there's the most renowned Warren Buffett style of trading called value investing. Now, if you really take a hard look at this matrix, this strategy spectrum, you'll see that almost all of this, including value investing, can be expressed as a rule. And as long as you can do that, you can do a systematic trading on that. So there are misconceptions that value investing is fundamentally discretionary. Actually, that need not be the case. It all depends what sort of data and what sort of information you are looking at. For example, there are many funds right now who actually, apart from taking in fundamental data, those balance sheet and P&L ratios, they also look into natural language processing, into the management accounts and the reports, and they make a value decision based on that. And that is nothing but value investing doing systematic way. Cool. So with this short background, I think we are now ready to move into the main part of our topic today, trading strategy. Now, what is a trading strategy? The strategy, a mathematical definition of strategy comes from the discipline of game theory, according to which a strategy is a set of rules or a well-defined algorithm that can allow you to choose an action from a possible set of actions in any state of the game. That means no matter what happens, in which state of the world you are, you always have an action which is predetermined. And for trading strategy, it is pretty much the same. It is a set of rules that tells you when to buy, when to sell, and when to hold, do nothing, no matter in which phase the market is in. Of course, for trading, the game is quite complex. It's a multiplayer, massively multiplayer game. There are so many market participants, and also the underlying engine, the generator, is quite random and stochastic in nature. But the main thing remains the same. So you have to create a set of rules that will allow you to choose an action and act on it, of course, given any state of the game, any state of the market. Now, in terms of if you use a bit of symbology, so the way it flows is that first we start with some input data. It can be price, it can be volumes, it can be, as I mentioned, fundamental data, or even the outcome of your natural language processing, anything. So we have a set of information which is continuously streaming. Your main objective of trading strategy is to create two things out of this. First, define a signal function that is a function of this incoming information that will generate a buy, sell, or hold kind of signals. That is, it can be a discrete, it can be a continuous number. It will generate a signal that will tell you whether to buy or sell or hold. And then the next step is to come up with a positioning function that will take the signal as an input and convert that into a target position for that particular underlying. So for example, if you are doing constant signal function, so if your signal is 1, you want to sell, you want to buy 100 shares. If your signal is -1, you want to sell 100 share. And finally, once your position is done, that is what you trade. And then you get the realized return in actual market. What happens? Of course, this is outside your control. You cannot control this, which is the capital R in the last line. And this creates your total portfolio value. Or if you subtract your initial portfolio value, this is essentially your profit and loss. So we start from the information. In strategy design, we design two functions. One is the signal function and one is the position function. Sometimes people say sizing functions as well instead of position function. And then finally, once you're done, you do the trade and you get the, you reap what you sow. The objective of strategy development is to find S&P, and the objective of strategy optimization is to optimize a function of pi given some constraint by changing S and P, or by changing the parameters of S and P. Cool. Now this semantics is behind us. Let's get into the stages of a strategy development. So strategy development always starts with ideation. That is, you either have experience in the market, you have made some certain observation or some read about some empirical research or some economic research, or you heard something from some forum or some other places. You tend to form some ideas, and the outcome of this ideation phase is a verifiable hypothesis. Now, mind this word, verifiable. If your hypothesis is not testable, there are many examples of it. If your hypothesis is not testable, then you cannot really proceed from here. So you must come up with a concrete statement of your hypothesis or of your trading rules that can be tested. And once you have done that, the next phase is actually carrying out the test. This is the first part is, of course, to do the testing, you have to convert your rules into some form of programmable rules. So if you are using Excel, it will be some sort of if and else clause. If you are using some other languages, it will be functions or classes or whatever that language semantics are. And then once you've done that, then you have to test it. And you can test in multiple ways. One way of testing is one of the most popular way of testing is historical data, which we typically call backtesting. So backtesting is running your rules over some historical data and see that whether the rules generate profit or they don't work at all. The other way of testing is generate simulated data, which is also called bootstrapping sometimes. So we'll talk a little bit about it later. And another easy way of doing it, of course, is running live trade directly. Some execution partners or brokers or exchanges, they sometimes offer doing this in an easy way. That is called paper trading or demo trading. So you do it live, but you really don't deploy actual capital, fictional capital. And the advantage of doing this way is that you really get to see what actually happens instead of knowing what happened in the past. The disadvantage is, of course, it will take a long time. You can test it on 10 years of data in probably few minutes, but if you want to test your strategy live for 10 years, you have to actually wait, of course, for 10 years. And the outcome of this testing phase is finally, you estimate the risk and P&L profile. And once you have done that, the next step is, of course, deployment. And before we deploy a strategy, we have to be very careful about who we choose to execute our trades. And also, more importantly, you have to be very careful about risks that are not captured in your testing phase, especially risks like operational risk or examples like your network going down and et cetera, et cetera. And Finally, you have done that. Of course, you'll be looking for your next strategy and you go back to ideation. So what we'll do in this session is that we'll go through each of this phase and we'll see that how it is done with some special emphasis on optimization. Yes. So before I move into that, just a bit of words on how we quants see the risk and PNLs in our strategy. So there are a couple of equations on the top of the slide. If you're not familiar with it, it is not utterly important to be so. In case you're familiar with CAPM, it will look a bit familiar. And unlike CAPM, it is a bit different. So what it says is that for the ith stock at the tth time that goes into the subscript for R, the return R is sum of alpha, which is a constant, plus sum of the differences in a quantity called F multiplied by a factor called beta and something called epsilon. The epsilon is typically an error term. It's a white noise. It captures the randomness specific to that stock I. And the F are called factors. If you are familiar with CAPM, then you have seen only one F, and that is called the market return. So if we expand this, it becomes what is commonly known as arbitrage pricing theory, and we have many factors, as we know, if you're familiar with the factor models from Fama and French. So they all become part of this equation. And when you take expectation on both sides, expectation means you are trying to statistically compute, okay, this R is fine. It is what the realized return is. But if I look into the future, what I can expect. So there are statistical methods of doing that. And if you do that, you come back to the second equation where you see that that term A, alpha, degenerates to RF, which is typically known as risk-free return. And the term epsilon disappears. And the reason is that if you are, when you know more about asset pricing theories and the typical assumptions economists work with, so the assumption says that in epsilon, you can diversify this idiosyncratic risk so you don't get paid for it. So that's why it is not part of your expected return. And similarly, alpha doesn't stay in the market. It gets arbitraged away if the market is efficient. So you end up with only the risk-free return. And the expectation of the changes in the factor, that delta F, they become what is known as risk premium. Cool. So now the chart becomes very easy to understand. You have profit and loss. So if your profit is coming entirely from the constant A, it is called alpha. If your profit is coming from the beta part, the part in the middle, it is called beta. If your profit is coming from the error terms, the epsilon, it is called idiosyncratic. Idiosyncratic, you cannot really sustain. That's by definition. If you are going for beta, if you only assume that my one factor is market, then it is typical of passive broad-based indexing. That is, you buy, say, S&P ETF, SPY, or you buy some whatever index you're following, you buy their ETF. If you are also, if you think that apart from market, there are other factors also, which typically most people do, and I agree, then you buy the factor ETFs. In fact, in the US, the factor ETFs right now is just multiplied like anything. So you can buy value factor or momentum factor and so on and so forth, quality, growth, etc., etc. And on the alpha, you have more or less two ways of doing this. One is either you select in such a way that your selection creates that, or you try to time so that you know when exactly to buy and sell. And of course, this is not easy. There are a few points down below. I'm not going to go through them. You can refer to this later, but what is important is that alpha means your constant A remains the constant. And that is a very, very difficult thing to happen. And market timing means that um, your factors, or including the market factor or many other factors, their changes, the delta F, are predictable. And if you really don't believe in any of this, that is, you don't believe that I can select a set of strategies where I can capture constant A, or I can predict the changes in the factors, then the only option for you is passive investing. So the next slide is useful to you only if you believe you can do one of this. Welcome to quantitative trading strategy development. We start with a very simple trading strategy, and I'm pretty sure that almost all of you have heard of this before. What you're talking about is known as opening range breakout. Now, we start, if you remember our phases, we start with ideation. So the text in the top left corner in blue will be there in all the slides from here now, and it will tag it in which phase of the strategy development we are in. So as you can see, we are in ideation. So this is a chart for a particular stock that shows a particular day where the open price was down, the high of the open bar was way down from the low of the closing bar. And the observation here is that this happened, and it was followed by a further sell-off in the stock. And then we have just the opposite observation for the same stock, actually. In fact, the very next day, the opposite happens. The open low was much higher than the closing high, and the result was a further rally in the stock. Now, notice that we have just made two observations. We haven't made any hypothesis. So what is the next step? If you think the next step is backtesting, you will be utterly wrong because we are nowhere near the backtesting phase. Our observations are good, but are they just stories or are they statistics? We do not want to jump to backtesting right away because firstly, it is hard. We are not sure whether it is worth our while. And also, we do not have even a concrete set of rules to backtest. And more importantly, we just have one observation and one outcome. The observation is the opening bar closing higher, much lower than the closing bar, and the outcome is rallying or selling off. But we do not have any insights into how they're related. So let's try to do this. Let's try to do a deep dive. What we'll do is that we'll get the daily prices. Although you see that we're looking here at intraday prices, and the strategy itself is intraday that we're talking about, but we're looking at the daily prices. That's the reason. Why? Because it is easy. It is quick and dirty way to get an idea. Because you'll be having many ideas. Ideally, you'll be having many ideas than the ideas you actually end up testing. And the number of ideas you test will be much higher than the ideas you actually implement, deploy. So since we'll have many ideas, we cannot do very detailed deep dive into each one of them. So we need to get started somewhere. So we start with the daily prices. That is one. Number two is that we start with not just one stock, we start with a bunch. Why? If you remember the slide where we talked about N, how the asset manager B was beating asset manager A. So we don't want to lose that. Cool. And of course, if something we find which is only applicable for a single stock, then probably it's just a statistical fluke. It is not really a tradable strategy. So what we'll do is that we'll approximate the opening range gap as a gap between the last high or low as it is applicable, whether it is up or down, versus the next open. And we'll approximate the subsequent move as the difference between the same day close minus the same day open. And we will be using lock prices just to make things easier for us. And let's see what happens. So what I'll do is that I'll quickly switch into quick and dirty way of doing this. I'll be using a bit of coding here. The coding here I'm doing is exactly what you mentioned. We are trying to get a bunch of stocks. We're trying to get their daily open, high, low, close data. We are computing the trading signal as the difference between today's open versus yesterday's low or high. And we are trying to approximate the subsequent rally or sell-off based on the opening, based on today's close versus today's open. So we have, this is R. If you're not familiar with R, it's absolutely fine. We could do it in Excel as well. We could have done it in any other language like Python. Excel, it will be a bit tough because the kind of operations we'll be doing, it gets very quickly very, very complicated in Excel. Nevertheless, it is possible. And it is much simpler than if you really pick up a programming language. For this, I chose an R because I'll be doing mostly some exploratory analysis, which is essentially plotting some graphs. So I find it is a bit easy to plot graphs, beautiful graphs using R compared to any other languages. So here we are. So I have choose a range of stocks here: Microsoft, Apple, Amazon, Google. You see, it's not just one stock. It's quite a few. Actually, there are, I think, 20 or something. And then I have written some functions. So the first function is you don't have to really look into it. You don't have to understand how it works because I can share all the codes. You can have a look at them later at your leisure. Right now, it's important to follow the flow. So what you are doing is that we have a function that reads the data. Then we have another function that extracts those two signal and outcome we talked about. That is the difference between today's open versus yesterday's low or high, depending on whether the open was higher or lower. And the outcome we want to predict, which is today's close minus today's open. So we read the data, we read the stocks data, price data, and then we extract these signals, and then I have written a couple of functions just to plot. So if we do that, so we run the data, and then my data is, if you look at it, it starts from 2008. It ends at 2018 April. The X column represents the cases where there was a gap in the opening, exactly the kind of things we are trying to extract. And this value is the difference between the open minus last bar high or low, depending on whether it was positive or negative. And Y is the day's move, that is close minus open. X is the signal we are trying to capture. Y is the outcome that we are trying to predict. Now, let's see how it works. The simplest thing is that the first what we want to do is that we want to subset the data because 2008 and till at least around 2013 was really a pretty different world. There was too many things going on: financial crisis followed by the European sovereign crisis. In between, you had the US Treasury crisis, the man-made one. But anyway, we'll subset it just to make sure that we are not sampling data that is no longer relevant. So we'll start from 2013, and then we'll plot the data. What we'll plot is a scatter plot, that is X versus Y, and see how it works. So we see that the green one is the cases for positive X, that is when there was a gap up. The red one is cases for negative X, that is when there was a gap down. Now we see that it is highly nonlinear. It's not very clear, but if you zoom in, you'll see that initially, as the gap increases, it tends to move in the same direction, but after a while, it flips. That is, initially shows some sort of momentum, and then it flips back to a mean reversion. What we'll do is that the X, just for your information, I have standardized. If you are not sure what is standardized is, you don't have to worry. Standardization is a method so that we can scale the value of X to something which is comparable, because we have picked many different stocks. They have their different volatilities, different prices. Something is trading at 20, something is trading at 1,000, and some may have some 20% volatility a year, some may have only 8%. So if we need to compare them, we need to standardize them. So it is a way of standardization. I've just done it by the standard normal way. So it will range from, it is basically scaled by the standard deviation of the underlying series. So if we see that the cases where our samples are within 2 sigma, that is our X is less than 2, the plot looks slightly different. Now, this is the one we are talking about. If you zoom in, if you zoom in, then you see that the momentum phase. So for small standard deviation, that is for small amount of gap up or gap open, gap down, it tends to move in the same direction. So what we saw in those two charts before, for one particular day gapping down and selling off, the other particular day gapping up and then rallying, seems not an anecdote, seems more like a statistical phenomenon, because we have done this not for that stock, not even for that market. That was a Reliance stock, which is a large cap in Indian market. This is for S&P 500 stocks, top 20. So it is very different, and it still seems to be holding true. So it seems that there is some merit in that observation. It's not just a fictitious one. So let's go back and see that if we can do something about it. So this is what we have, just what you're saying. So first step, we define the rules. Now, there are too many text on the slides, so don't bother reading them. Just if you listen to me to be clear, what we are trying to do is that we are trying to translate our observation into very concrete statements or rules. Our first rule is how we compute the signal function. To do that, we first have to define what is opening ranges. So what you are saying is opening range is the first candle, that is the open, high, low, and close data for the first 30 minutes after the market opens. And we define the closing bar as the daily candle from the last trading day, yesterday. Again, open, high, low, close. Our signal function is first, we compute the gap between the opening range and the closing bar, and we normalize by the calculated volatility of the stock. If the closing bar high is lower than the low of the opening range, that is, it is a gap up, the signal is positive, and we enter whenever the high of the opening range is breached. We enter a long position, of course. And similarly, just the reverse for the short case. If the closing bar low, that is yesterday's yesterday's low is higher than today's high of opening range, that is we gapped down, then the signal is negative, and the entry level is the low of this opening range candle. So this is our signal function. That's fine. The second one is that how we define um, the position function. The position function is, we'll keep it very simple. What we'll do is that on any day, if you get any signals if you get signals for n number of stocks among 20, then we'll deploy our capital equally for all of them. The entry rule, only the first 1 hour after the opening range will be allowed to enter into a fresh trade. Once within this time period, we have the entry level breached, we enter a long and short depending on the direction of the signal. And our exit rule is that if we on a day have any entered trades, before 30 minutes of the market close, we check all of them and square them off. So it's a day trading. We wait till 30 minutes to compute the opening range from the market opens. Next 1 hour, we do all our entering. Next 1 hour, we wait for the opening range breakout. Once it's broken, we enter according to a signal. Then we do nothing. We wait for the whole day, just 30 minutes before the close. We square off our positions. Let's run the backtest. To do that, I'm going to use a platform called Blueshift. This is from QuantInsti. There is a platform to research your trade and also go live with your trade if you find a good one. It is a platform where you need to have familiarity with Python to code because unless you are familiar with at least one programming language, it is very difficult to test your trading ideas. Excel is simply, believe me, is not enough. Even if you are able to express very simple trading strategy, very simple trading strategy almost always do not work in the market. You will look for complexity and then Excel will become too complicated. Anyway, so let's go to the Blueshift. When you log into Blueshift, you will enter into a screen like this. This is what you call workspace. You see that there are all these folders and other things are there. So you can create a folder, you can get into a folder and create a strategy. You can also cut, copy, paste, and delete and do all those things. So what I've done is that I have created a folder called this, and I have some pre-built strategies there. And then we'll start with the logic of the first one, the very simple rules that we have just laid out, and see how it works on Blueshift. Now, mind you, we have some questions about some different rules. So the question is not what the rule is. So you can pick and choose whatever rule you want. The main focus is that we have selected a certain set of rules. We see that this is probably statistically, from a deep dive, probably statistically it is correct. And it seems that there are some momentum in the short range, as we have seen in these charts in the hour. And we just want to test it and see that if we can improve. And now it is not a lecture on how to use the platform. In fact, in EPAT, we have a detailed lecture on this because this platform can do many things, almost anything that you want to do with your trading strategy, including technical indicators and quant strategies and machine learning strategies, anything you can imagine. But today we'll be focusing mainly on the trading strategy that we are talking about, so we'll not discuss about all of them. What we'll do is that instead try to understand how it is coded here very roughly, not from the point of view of how to code, but rather from the point of view of understanding it. If you need it, I can share all these codes later after the presentation, so you can go at in your leisure time. But now, as I said before, it is time to follow the logic. The first thing we are doing is that we are using some variable called context, which is part of. So we are defining a bunch of functions. So the first function is a function where we are defining some placeholders, some variables. We are initializing them as 0. So if you're not familiar with Python, do not worry. These are just means that they are set to blank things. Cool. Next one, what you are doing is we are first creating the universe. So in Blueshift, you have to tell what are the stocks you want to buy. And for telling that, we use a function called symbol that takes in a particular string and convert them into an object of type asset. So here we are creating a list of asset from this list that we have seen before in our R session. So in this, we are storing the list of stocks that will track. The N is the number of stocks we track. Here N is 20. All this, Microsoft too. I think this is MasterCard. Cool. Next is we need to compute the signal, the detailed rules that we have talked about. How we do it? It is pretty simple in case you are familiar with Python and if you are using Blueshift. I will tell you how to. If you are not following the programming part, do not worry. You can pick it up later, either going through the Blueshift material, which is freely available online, or you can join the EPAT sessions and you can get even more details on all of this. But the basic thing is that first we query the data, the historical data for all the stocks. So all the stocks we had, we query the data. So all those data is here. What we query for open, high, low, close prices. For how long? For this number, which is down below 60. So we are querying for the price data for 60 days and daily price. 1D means daily, 1 day. Once you get the data, then we look through all of them and extract the price. So for this particular stock of this 20, we extract the price. We find the current bar. We find the last bar. And we also find all the prices, including the current bar. And also we compute the volatility. To compute the volatility, we are just importing a function from our built-in libraries. Once we do that, we first compute the gap up. The gap up is the current low minus the last high. Gap down is the last low minus current high. And then as we decided that we will be normalizing by the vol, so we are dividing the gap up by vol and gap down by vol. And our trading condition becomes, if this long condition is true, that is if the gap up is greater than 0 after normalizing with vol, then we are in a bullish phase. So we want to enter long. Similarly, if the gap down is large, then we are in a bearish phase. Otherwise, we are neutral. So this is a pretty simple calculation for computing our signal. And then we have also two other small functions. So what you do is that this function turns off our trading after a certain period of time, as we decided that we'll only be open to enter in fresh trades till 1 hour after the market open. And then another function to unwind or square off all our positions. Again, to do a square off, you have used another help function from our built-in library, this one. So again, this function will be called just 30 minutes before the market close, and it will square off. So now we have the main signal function. In signal function, what we are doing is that we are looping through all the stocks in our universe. We have, mind you, already calculated the opening ranges and which phase we are in, bullish, bearish, or neutral. That is what we are getting here. And if the mood is bullish and the opening range is broken, we create a +1 signal. And if the mood is bearish and the opening range is again broken, towards down, then we create a negative signal. And once we create this signal, we need to place trades. And the placing trades is happening here. We are computing the number of signals that we have, and we are computing how much we should allocate to each of the signal stock that we have. And then we just go on in a loop and we place the trades. So that's pretty much it. And then we basically schedule this functions here to call them in accordingly. So for example, the calculation happens after 30 minutes, as you can see here. We turn off the entry after 1 hour 30 minutes, that is 1 hour after the calculation happens. And we unwind after just before market close, 30 minutes before that. We also set the trading commissions and slippage there. Later on, we'll change it. Okay, and on every minute, this function is called automatically by the platform, and all it does is that whether we are in a trading state. If you are in a trading state, we just enter, right? I have already run the backtest. To run a backtest, what you have to do is to go here. You have to select the range. So, for example, we can select short range, and we can put some capital here and just run it. What you get here is that this is we called quick test, quick run. It will give you some headline statistics, and also it will stream you the output in real time as and when it happens. But if you really want to get more details and list of transactions and more statistical measures, you have to run a new backtest, which you can do from here in a very similar manner, which is fortunately I've already done it. So if you go to the backtest, quitting the quick run, and see how it looks like. So this is what our backtest is. It's not a great one, actually, as you can see. So we rallied up quite a bit in the beginning, then we had quite a bit of drawdown, and then again in the end we rallied up. So it's okay. It's not very bad. It's a decent starting point. But obviously what you need to do is to optimize. Back to optimization. So this is about the slide just you have seen, but we'll skip it. We already seen the real thing. So the question is how we go about the optimization. Before we even started, we have to first estimate what are the parameters in our strategy. So the first parameter is the signal threshold. Which is signal threshold? If we go back and see the strategy code, we see that we are entering or entering a long and short based on this condition. So gap up greater than 0 and gap down greater than 0. So 0 was the threshold for our signal condition. So that is the first parameter. Next one is the volatility calculation day, which was 20 day we just saw. Then other things are the 3 times, that is when we compute the opening range, when we stop entering fresh trades, and also when we exit the existing trade, square off. And finally, we had a binary position function. If you're not sure what is a binary position function, we'll talk about it a bit later. So what we have here is that we have a function, an objective function. Say, for example, if you just simply want to maximize our total returns, or you want to maximize the Sharpe ratio or anything you want. So that is, as you have seen, it's a product of your positions versus the market returns. Now, market returns is not obviously under our control, so we can take it out of optimization equation. We can just simply multiply with it. And then it becomes a function of the signal, which is a function of our parameter space, the capital theta, and the input information, that is the I. The first thing people do is to run a search. So we have all these parameters, how many? Some 6 parameters we have. And what people try to do is to run a search by changing the parameters within a range and see that what combination gives you maximum objective function, maximum Sharpe or maximum return or minimum vol, whatever. If you're doing this, you need to stop now. Many platforms actually offered this as a feature that you can run this exhaustive thing, or we use genetic algorithm or use simulated annealing or machine learning or whatever that. But this is a very, very wrong way of doing things. Why? The scientific way of developing a strategy is what you see on your left-hand side. That is, we ideate, that is where we started. Then we hypothesize, that is what you've done, and then you evaluate. And unfortunately, in most of the cases, the evaluation goes wrong. It is not as good as we expected, we hoped for, etc., etc. So what you do is that, ideally what you should do is that whatever doesn't work, we throw them away. Whatever works, we deploy, and you go back to ideation. What you end up doing is something that is depicted on the right-hand side, which is we evaluate, it doesn't work, we optimize, and then we deploy, and then we get into a circle. The backtests are useful for hypothesis testing. It's not a data fitting tool. If you are doing this parameter search to maximize the objective function, what you're essentially doing is data fitting. What you're essentially doing is optimizing your strategy for performance in the backtest. You're optimizing your strategy for the past, not for what you expect in future. That's one of the reasons that in Blueshift we do not offer such tools. What is statistically, what is the problem with that? The problem is that if you're interested, there are some links here on some research papers, but it's very well known among quants that you have to adjust your Sharpe ratio based on number of this kind of parameter search you have done. So for example, if you have run, if you have computed that your Sharpe ratio is 1.5 and you have done a combination of thousands for different parameters, actually your Sharpe ratio is 0. This graph tells you that. So next time you do that, just remember this graph. So what is the correct way of doing things? So you have more or less only two ways. The first one is that either you simulate data, which requires you to do a very detailed time series modeling, which is very, very, very difficult. So we'll not get into that today. The other one is you do economic or a research-based approach, which is you observe what goes wrong, what can be improved. The downside of this approach is, of course, it's very difficult to generalize. Now, the first optimization test that you can do is that if you go back to our session and if we try to see that how the probability distribution of y looks for different x's, we can generate this. So for example, if x less than minus 0.75, the standardized value of the gap down, then what is the distribution of future move? As you can see that we have plotted this for a number of things, and it seems that for there is an optimal value for this, both different for the gap up and the gap down. So for a very small value, it is not very effective. For a very large value, it's not again very effective. There are some optimal value in between. So what we did is that we tried that on Blueshift. So this is our first improvement. This is exactly the same code that we had before. The only change here is this. So we changed our threshold. And then of course you can run the backtest. I've already run, so we don't have to wait. And if you see the backtest, oops, it doesn't work. So obviously searching parameter space not always works. This is what essentially we did. We just searched the parameter space in R. So what is the next approach? So this, what it did, doesn't work. What about we try to improve it conceptually? So if you're familiar with optionality and option theories, there is an interesting thing we can do here, which is to put a take profit target. A day trade is day trade in our case is basically you're waiting for a particular signal in the open and then getting into a trade and waiting for the trade to end in money at the end of the day. Versus if you put a if you put a take profit target, it is something like whenever that price is touched, we do our exit and we lock in the price. So I have done some short analysis between this, comparing the first case as a one-day Black-Scholes option and the second one as a one-touch option and a barrier option. You guys are not familiar with barrier options and all this. It's not a problem. The basic takeaway is that it increases your win rate. That is, you win more time, but the cost is that you will fail to capture a large upside because you just were happy with be settled with your small take profit value. Now, when it works, when it doesn't, it works when your prediction power is not very good. That is, you are not very sure that your signal positive really means your momentum is up or not. When the prediction power is high, in this picture, the Sharpe ratio axis, then actually it doesn't work. You should do a hold till the maturity, in our case, hold till the market close. But since we are in real life, in most of the cases, our prediction model is not very good, so we can try out a take profit strategy. And this is exactly what you did. So we go back to Blue Shift again. So we look into our second improvement, which is named unimaginatively second improvement. And the only difference is there is this handle entry was before. We added another function called handle exit. What it is doing is that it's doing the very same thing. It is going through all the stocks that we have entered, and we are getting the entry level and the volatility and the move that has happened. And if the move from the entry level to current price, if greater than our profit target or less than the minus profit target, whichever way, we place an order for 0. That means we square off. That is, we are locking in the profit here. How does it look like? Again, let's go to the backtest. It's markedly improved. So the Sharpe ratio from point, I think 4 or something has now gone up to 0.91, and we have improved in across all the metrics. We have improvement in the drawdown, we have improvement in the stability of the time series, and etc. etc. Now here, if you're not very sure about the stability of time series, is one of my favorite metrics, which basically says that if you start from this start of the trade, end of the trade, draw a straight line, how it is like how close it to a if I draw a straight line, how close it to the actual equity curve. If the equity curve deviates from that straight line too much, that means most of your profit was made by one or two cases. And if it is exactly the straight line, that means you had a very consistent rate of profit generation. For quantitative trading, we are always looking for the second one. Your stability of time series should be as close as to 100% possible. 100% means your equity curve looks exactly like a straight line from start to end. Cool. So we see that using this proper theoretical insight, we are able to improve the trading performance a lot. The question is, can we do better? As you can see that we have already seen these two charts. When you are looking at the R, we see that there is some non-linearity here. So non-linearity puts in some certain downside when the move is very high. Then we are following a momentum trading strategy. It basically goes into the mean reversion region. So the next thing we can try out is actually put a upper bound on the signal generation thresholds, right? This is what you have done again on Blueshift, of course. So this is our fourth improvement. There was another third improvement that I'm not talking about, which is essentially we tried to increase the take profit, and we saw that the thing didn't improve much. So that's about it. So the fourth improvement, so we are already having a take profit target. The extra thing that we are adding here is this much. So in our signal generation condition, we are not only putting a zero threshold for entering, and also you're putting a upper threshold. So we have a lower threshold and an upper threshold. So we want to make sure that we are not overstepping into the mean revision region of the signal versus outcome relationship. We are avoiding non-linearity. If we do that, and again, if we run the backtest, we see that we have another step improvement. Last time it was 0.92 sharp, it improves to 0.94. So it avoids some certain cases when it was getting hammered by the mean revision regime. And more importantly, we have improved the drawdown a lot. It was, I think, 30% or 35%. Now from there, it goes down to 25%. So it's a very decent drawdown profile. Now, can I do again something about it? Or is that it? Of course not. Why? Because so far we have just talked about the signal function. We haven't talked about the position function. You remember we had S and P in our trading strategy equations. So now what about the position function? Now, before we do that, slight digression. We we did something on the profit taking. Should we do something on the stop loss as well? People varies in opinion, but for me, it is a strictly no. Stop loss, if it is not a part of your trading model, it's a natural part of your trading model. If it is not, it should be only treated as a risk control mechanism and not as a signal mechanism. In certain cases, stop loss can be part of your natural part of your model. For example, in continuous momentum trading. In all other cases, stop loss is a losing proposition, theoretically. Especially if you do not have positive autocorrelation in your returns, and especially if you have trading cost. Of course, we have trading cost. So instead of using a stop loss in signal generation and trying to stop out of it trade by trade basis, we should use stop loss as risk control and trying to stop out of a whole strategy if it loses a certain amount. That is a risk control mechanism. The former, a trade by trade stop loss, is a signal mechanism. We should avoid the latter. And finally, the position function. So far we are using a binary position function. I promise that we'll come back to the position function. So what you are doing is that if the signal is positive, we go full bond, we go full scale. And if the signal is negative, also we go full scale on the negative side. But if you replace this with something that makes more sense, for example, a sigmoid function, which is this black S curve that you see here, these are some possible signal function that you have. Reverse sigmoid, sigmoid step function, linear function. You can even use what is very popular in machine learning called ReLU. And what we'll try is that the sigmoid function. And the sigmoid function, the good thing is that it slowly and slowly will add to your position. And if your signal is very strong, then it will go to full allocation. Um, that means that when you are near the zero level in signals, we're not very sure whether it is actually positive or negative, because of course there are always some error in our estimation. And we avoid doing a very large amount of trade into that zone. So what I've done is, of course, as you can guess, we have tried that as well on Blue Shift. That is our fifth improvement. The only thing is everything remains the same since fourth. In the last stage where we were doing actual order placement, I have introduced this signaling function. So this is using some standard form of sigmoid. It is very, very standardized. You can always have a look at the code later, come back to me or the or QuantInsti teams. So what about now? Now we see that we have a great leap in our performance. From 0.94, we went to 1.28. From minus 25% drawdown, it gone down to 11% drawdown. And overall, almost every metrics look great. Stability of time series is now 80% from 84% actually from 75%. Of course, so far we have just done with zero cost. So the last test I ran was using some sort of trading cost. The trading cost that we have included here is what you face in the real market. For example, I have used here you can see the cost is 5 bips. So 5 bips trading cost is very standard. In fact, these days you even have zero cost trading like many different discount brokers. So if you have 5 bips, then it slightly reduces, of course. So this 1.28 or 29, whatever you saw, becomes 1.15, but it's still a great improvement. So this is our final strategy. Now, is that it? Unfortunately, I think this is the time. But if you need not end here, you can continue optimizing. What are the other possible optimization? We can add filters. For example, we can add filters on volatility. Why? Because we are using a profit target, and we have a higher chance of hitting the profit target on when the volatility is high. So obviously, we want to put a volatility filter. We can even put a market regime filter, because as you have seen that depending on the size of the market, we have some sort of change. It goes from positive to negative. It flips the nonlinearity, as we talked about. So we can put a regime signal. As you can see that in most of the cases, our strategy didn't perform very good from 2016 to 2017. In fact, if you want to know why, we can actually get into the data that we started with. So we'll subset the data from 16 to 17, and we'll try to plot it. And we'll see that actually, this was the earlier plot. We see that it remains positive for small range, but during the 16-17, it actually went down to the other side. So there was a market regime break during that period. And obviously, we are trading based on our assumptions, so it didn't perform. So what you can do to optimize is actually introduce some sort of regime switching mechanism like a hidden markup method and all those things that you get to learn about when you join EPAT. Apart from that, you can also do something like an adaptive strategy. That is, it will keep track of your profit and loss, and it will flip the signals depending on whether it's consistently making profit and loss. There are many advanced things. These are mostly based on machine learning. That is also largely covered in EPAT lectures. And finally, the final thing is, of course, how to go live. I think the US market is not yet open. We can go live with one of the strategies. So on Blue Sheet, for example, we can go live by simply, if you go to our strategy, you click go live. It asks you something to confirm, and once you confirm them, then you get into our live trading strategy, live trading portal. And in live trading portal, you have to go through some very simple steps. You have to go through some settings. You have to select some brokers and go live. But before you go live, there are some things we have to remember. The first thing is that, as I said about the operational risk and all, so you first have to determine what is the trading profile, how often it trades, how sizable the trades are, what is the average holding period. Based on that, you want to tune your risk control parameters. Secondly, the operational risks. What happens if you get bad data input? Because according to Murphy, it will definitely happen. What happens if your connection breaks down, if your broker server is down? So based on all of this, so you have to have a set of risk control measures. The minimum list is that you must have a limit on the maximum number of trades you can do per day. your strategy. This is to avoid machine gunning. Like it's like firing a machine gun instead of bullets. You're just sending trades. That's a strategy gone rogue. Then you must have a limit on the maximum size per trade, the fat finger error. You must have a drawdown limit. As I said, that the stop loss is best implemented strategy-wise instead of trade-wise. And you also must have a kill switch where you can stop the strategy once you want to. So in Blue Shift, you can do all of this. You can go to settings. You can see that you have all this selecting thing, selectable things. So 5% means if a strategy is process 5% of loss, then it will automatically kill itself. Similarly, we have order limit, size limit, and everything. You can also turn on this to receive notification in case you have your Telegram app installed in your mobile. Once you're happy, you just select your broker. We have a few brokers already integrated. US Alpaca is perfect for this strategy. And you have to put your capital and then just have to accept the terms and conditions. Finally, you confirm what you want to do, and you land up in the trading strategy live dashboard, and it tells you what is happening one by one. Now, this will probably not trade now because the market is open, so we'll leave it at there. We'll go back to our presentation instead. The final thing is that the most important thing is that you should not have any changes between your that's code that you backtest and the code that you go live with. And this is a summary of what you have done. You see that we started with 0.74, then we tried a particular direction. The Sharpe ratio went drastically down to 0.29. It didn't really work. Then we actually tried scientifically from economic insights, and then we ended up from 0.74 to a very respectable 1.28. And we went through this ideation, testing, and deployment phases with a special emphasis on optimization. So that's it. In case you have any questions, please feel free to ask. We have a question of that. Do you have a sample strategy on Bitcoin derivatives? So we do not have Bitcoin's support for on the Blue Shift, but all these strategies that we have described. In fact, there are a bunch of other ones in our GitHub repo. If you search QuantInsti GitHub, you will get a bunch of a big repo called Blue Shift Demo Strategy. You can go and see there, and also you get to know many other strategies during your EPAT. And I'm sure that many what you learn from for one asset classes will be also applicable for others as well. Is the recorded version of this session available? I think yes. So you can definitely watch from the beginning. There is some questions I'm not very clear about. What about the losses on 44% of the stocks in case of B? So basically, if you're not clear on the maths, we can talk about later, but it comes from some pure statistics that you get an age if you can track many stocks together, which typically is the case for quantitative trading. Is the position function simple or more mathematical? So as you have just seen, I think we have already answered this. The position function is almost never that simple. In most of the cases, you get a binary position like you go long or you go short, but in most of the real cases, you are never that simple. Sigmoid is the one that is used in many cases, but in some cases where your signal can flip your position. So if your signal is simple X, you can use a sigmoid function that will be locally best positioning function. But if your signal instead of X, if it is X minus X square, then sigmoid is very tricky. So it depends from application case by case basis. And please share some videos which can help understanding more on Blue Shift. Definitely, we have some videos already on YouTube. We are making more, so that's fine. Can one include an indicator code on the parameters of that indicator, for example, RSI? Yes, of course. Means if you start, you get ready-made things like RSI and all, but once you join EPAT and you come out of it successfully, mind that successful word, then you will realize that this RSI indicator is probably not as great as it is touted, and you will learn much better way of doing things like time series modeling and other quantitative techniques. There is a question that how different this program is from CQF. The major difference is the focus of the program. So this program is much focused on the practical aspects of trading. So if you are looking for being a trader or being a front office quant or being in a prop firm or being in a brokerage trading desk, so EPAT is a good choice for you. If you are looking for being a risk quant, so for example, the middle office or sometime rarely on the front office quant who are mostly looking to the risks and runs complicated stochastic differential equations and all that, which is much more theoretical, of course, needed. So that is more applicable choice for CQF. So it depends on what is your goal is. What statistics topics I should know for trading? So you can pick up the college level, college first year, second year level statistics, and if you can complete this, it's good. If you cannot, you can probably give EPAT a try, and we'll try to see that you come on the other side of it. Can you suggest any book in easy language to learn and quant and statistics for trading? So as I said, that you can pick up any college stats book. There are more importantly, quant is not about just statistics. It's developing the insights that how can I apply the statistics for trading. So some good books are it's not on the top of my mind right now, but there are quite a few blogs. So for example, QuantInsti has quite a few blogs, even other places like Quantocracy. And if you go to, for example, Quantopian, for example, they have quite a bit of good series on quantitative trading. You can also have you can also search for people like EP Chan's blogs, and you can also follow the quant hashtag on, I think, Twitter. That is also, I think, sometime have some good materials. And it is not about just statistics, mind you. You also have to have a very good sense of the economy and how they connect. So that is something that is also as important. Can you suggest after much optimization, the profit was 11%, 115% is possible to beat inflation? Yes, of course. Means if you are investing in FD, you are almost always missing out you are almost always on the wrong side of inflation. No matter which is the rate of FD, because typically the real rate of return is your nominal rate, that is you get from inflation, and minus the inflation, and the central bank, since the target FDs, so the nominal return follows very, very closely the inflation rate. So that's the reason why in fixed deposit, if you are not very risk averse, your real return will be always less than stock market. So for this particular cases, we didn't do it for we didn't check that what was the total return, but I'm sure that it was beating inflation. I'm pretty sure. from now the market is going down for 2-3 years and the strategy is having max drawdown of 30%. Can you make strategy based on bear market? Yes. So this is just an example strategy. So as I mentioned in one of my slides, that this is not an advice or this is not a solicitation. So so a couple of pointers I've already given you. For example, adaptive strategy. So those kind of strategies can adapt to bear or bull market on their own. And also, you can make a strategy that can work in any market. In fact, one of the biggest focus of quants are creating strategies that are market neutral. That is, they have zero beta. So it is not affected by whether we are in a bear market and bull market. If we can go back and check the beta, in fact, I missed it. I don't know. So let's see that. As you can see, my algorithm has started and it is now waiting for the market to open. If we go and see the beta of the strategy, so it seems that the beta is quite low. You see that there was a huge drop here, and we had a rally around this time. So the cases where the market is falling sharply, the beta was quite, the strategy performance was quite great. The only part where we lost out is during this 16 and 17. And the reason is that the assumptions that you're working on was wrong. Actually, during this time, the market has a different regime. It was in a mean reversion regime following a gap up or gap down, and our strategy was simply wrong. So the way to fix it is to actually either use adaptive strategy or use a better filter. So we just picked up very, very basic things and we had a quite a respectable strategy, and there is a lot of scope for improvement here. Can we create a signal based on fundamental data? Yes, definitely. In fact, on Blueshift, we are trying to introduce fundamental data. Fundamental data driven strategies are used by a lot of funds, and this is called quantitative fundamentals, and there are a lot of quant funds that are actually using it. For a trader, how this program helps in defining good profitable strategies. Now, you can get profitable strategies in three ways. One is that you suddenly one day get lucky and stumble upon it. Second, someone gives you a profitable strategy. Third is that you build it on your own. Now, the first one is very, very unlikely. The second one is if someone gives you a strategy and claims it's profitable, probably he's lying through his teeth. You can disregard that. And your most probable chance is the last one. And this program teaches you how to think so that you can develop profitable strategy, how to think in terms of statistics and quant application, in terms of how to translate those thoughts into a code. That's how you benefit as a trader. Is it possible to define levels, zones, local low, local high? Yes, you can do many things. So for example, one of the first thing people will think about here to apply some sort of candle pattern identification, which we haven't even touched about it. We tried to kept it very low because we have a very severe time constraint, as I understand. But yes, you can define many other things to make this work much better. Can one aim to become a successful individual algo trader, or is algo trading only suited for big institutions? Now here is a catch. What you mean by algo trading? So if you have in mind high frequency trading, the answer is no. You need an institution, you need big capital, and you need a very, very advanced infrastructure to even compete in high frequency trading. Now, can you become an algo trader in the mid to low frequency? Yes. Why? Because there are three kinds of participants in the market. Once you already talked about the high frequency. So there, your main alpha, your source of alpha is how fast you can react before everyone else. So it's kind of a winner takes all. The second one is the big funds like pension funds and very large hedge funds. Now, they are always in the lookout for winning strategies, but their range is very different. They don't want to look at a strategy that trades multiple times a day, not even a strategy that trades multiple times a week. The reason is that when you have some 2 billion or 10 billion to invest, this kind of strategies are simply not scalable for them. So they give them a pass. So in between this range where you're trading thousands in a microsecond versus once in a month or once in a quarter, there's a huge range where the smart traders and smaller institutions have really an edge because this is not touched by the big guy. And this is where you can actually make alpha. But of course, means the caveat here is that strategy development is not easy. It's tough. It's not for lazy people. It's definitely not that you will quote something, you'll go to the market, you'll make money. So if you're getting into algo trading, you have to be very serious about it. You have to be open to learn, and you have to be able to face failures. You need programming knowledge, or is it able to catch up during the training? A bit of programming knowledge is good, but it is not essential. We have cases where people came from arts background with zero programming knowledge and caught up. So as I said, that it is not for people who are lazy. So if you put in the effort, it is possible. So the kind of programming you need for this course is not that you are not creating great complicated softwares that handles multi-threadings and that does exception handling and all those kind of things. That's partly my job. For you, your application for programming is actually able to translate your trading ideas into code that carries them out. So that is a quite specific part of programming. So it is not as complicated because there are many different packages and routines and libraries available. So it's all about picking up a few stuff and more importantly, the insight how to put them together than learning about algorithm or data structure. So I would not say that you need to worry about that. Can you explain how to define local low and local high in algo language, like in the code? So as I say that this code will be shared, you can go to our repo, you can directly pick it up. In case you have difficulty, absolutely feel free to put a mail to any one of us. What are the essential skill set that is required for to excel well in algo trading? So as I said that there are pretty much two things that is required. One is ownership and one is ability to learn. Why? Because if you really own your success in this area, then you will do whatever it takes. And if you have the ability to learn, because there will be a lot to learn if you're not from this background, if you have that ability, then you will be able to live up to your ownership. If you don't have this too, it is pretty much impossible. So it is not that your prior experience is important. What is important is that how serious you are, how much hard work you're ready to put in, and how fast you can learn. What is your learnability? Of course, means if you have prior experience, if you have programming skills, that all helps. But as I said, that they're not the deciding factor. Can I get the code? Yes, you can. So we'll definitely share it. Please remember, this is again not an advice or solicitation. These are statutory warnings. So use it at your own risk. Can I use this for option trading? Yes, of course, means it will even work better for option trading because you have, we are using a take profit. So that is naturally like going along barrier option. So you can use the same. And in option, you have limited downside if you're buying. Which was not the case for us. So we are doing our stock trading. So we have the full downside. So it is, you are basically using a nonlinear signal generation and using a nonlinear instrument, and you get a double benefit. But of course, it will work for options when you are day trading. It will not work when you are holding for a week or so, because you will be basically slapped by the theta, the time value of money, time value of options. Will ML and AI be part of the program in terms of trading strategy and position sizing? Trading strategy, definitely. Position sizing, I'm not 100% sure, but you can get a confirmation from our sales for on this further. But strategy, yes. Can you please tell me where can I find this sample code? You go to, after a few days, go to our QuantInsti GitHub, QuantInsti, search QuantInsti, GitHub. You'll get a link called Blue Shift Demo Strategy. Go there and you'll find lots of code, including this one. Please try after a couple of days because we'll take some time to upload this one. Um, for doing simple option strategies like iron condors, we really need algo trading. Um, the algo trading comes in two parts. One is that, as I said in the first slide, very first slide, if you remember. So one is about taking the decision. The second one is about execution. Now, you can use, even for simple strategies, you can use algo for execution. In fact, all we talk about HFT, so this entire HFT industry actually runs very, very simple strategies. The reason they do it algo is about the speed, because a man cannot, or a woman for that matter, cannot trade that fast. So the HFT strategies are simple. Execution is most important. That's why I do it. For medium to long-term strategies, your alpha source is not the speed. So there we tend to more use strategies for selection rather than execution. Now, for example, if we talk about iron condors, if you're only talking about Nifty and if your execution speed is not important, you don't need algo trading. But as I said, that if you are using algo, you can at a time monitor options or 20 different stocks, and you can find, say, iron condor on, say, stock 1, maybe a butterfly option on stock 2, maybe something else on some other stocks. So you can actually monitor all of them and don't miss a trade. So in that case, algo trading really helps, right? How you can use alternative data. So alternative data is, I have some mixed emotions about alternative data. So it is now a fad. I think after a while it will settle down to a fact. So some alternative data are really useful. Some are quite useless. For example, people have been successful in trading news and they have sometimes been badly burnt by it. So it depends. I think we are a bit in the too bullish cycle in alternative data. I'll give it a couple of years. The way we can use alternative data is, of course, through NLP. Unfortunately, NLP at a fast scale, it's not yet very optimized, but still, as I said, in a couple of years, I'm sure it will be. And other things like people do, for example, some hedge funds take satellite pictures of number of cars in the parking lot to estimate the demand in Walmart stores. That is something probably, it's just like the old days. Once everyone starts doing it, it will just disappear. Can I include outliers like corona or recessions while trading? It depends. So for example, if you're selling vol, if that is your strategy, uh, you are sure to hit on one of these days on one of these outliers, and it is going to ruin you. So excluding them will be quite a bad choice. But on the other hand, if you are doing a trade that trades in a very specific band with a steady drawdown limit and all that, then probably if you include them, you are diluting your alpha signal. So in those cases, probably you should exclude them. So actually it depends, means it depends on the trading profile and the risk profile of your strategy. Um, can optimize itself, can strategies be created which can optimize itself on its own depending on market condition? This is what I just hinted. These are called adaptive strategies. So there are specific ways of creating this. Some adaptive strategies come from a machine learning thing called reinforcement learning. And there is also a parallel traditional statistical way of called model portfolio or no regret trading. So there are many ways of doing this, and yes, so now the question is that whenever you try to do this, you have some underlying assumptions that the market trend will stay for a while. So if your market is one day mean reversion, next day momentum, next day mean reversion, and randomly, then probably you will be worse off than choosing a simple strategy, because every time you switch, the next day it also switches and you get double whammy. So so there are some conditions required. So nothing is a holy grail in the markets. There are no free lunches, but yes, so this kind of strategies are in fact possible. Can strategies be built on various types of charts, Renko, Hekinashi? So you can do any way you can build strategies. The only question that whether they will be they will work or not, and the only way to find out whether they work or not is to specify the exact way how the strategy is going to trade, the rules. If you think that you can draw a pattern in the chart and you can convert them into a rule and you can test them, then why not? Only problem is that the people who trade from chart patterns often disagree about the pattern itself. So if you have disagreement, then it becomes a bit difficult to convert them into a solid rule, which you can code and backtest and optimize. So as long as you can do it, anything is possible, right? What kind of support is available? I want to start my own trading desk. Um, you can definitely. In fact, we have quite a few interesting cases where people started their own trading desk, quite big ones, after going back after passing out from EPAT. So you'll get full support. You can be sure of. In Indian markets, there is not much liquidity in stock options, so does algo trading work in such liquidity conditions? So you have to be careful what you're talking about. So if your strategy is about extracting this low liquidity premium, then this is your playground. But if your strategy is not that, then it is a madness to run an algo trading on such a market. So it all depends on what you're trying to do. So for example, I know some people who have done very simple market making strategies in illiquid option. Now, you have no chance of making money in option market making if you are a retail trader. But in illiquid stocks, that is the only place with certain risk, of course, you can actually do that because they are illiquid. You are extracting the risk premium. So one day you'll get bound, but if you can control your risk, there is why not? Uh, how you can calculate a trading size lot based on the dial volatility in algo trading? I'm not very sure about dial volatility. So probably you would like to send a separate email on this. Um, there are many other questions actually. So I think we are running out of time here. So I'll just take two more. The first one is that equities or commodities are which are more fruitful. So again, it so there is no asset classes that are better than one other than the rest. So the only thing is that you have to be aware of what we are trading. So for example, the commodities very over very long period, they exhibit business cycles, they tend to become mean reverting. On the other hand, equities over a very long period, they always go up. They try to catch up always with the inflation, as we discussed. So as long as you are aware of the underlying dynamics and the underlying demand supply situations and the economics, then both are possible. And the last question is that can it help in expiry trading, short gamma? Again, yes. So if you are doing expiry trading based on execution, yes. If you are doing expiry trading based on monitoring many number of stocks, yes. If you are doing expiry trading based on your gut feeling, no. Cool. So we'll stop here. And we'll be very happy to take further questions, and you can write to us. So for the concluding remarks, I will hand it over to Ria.
Thank you, Prodipta, for the wonderful session. It surely helps us understand the journey of a strategy. It is also wonderful to see such an attentive audience engaging. Though this is a representative lecture, it might have helped you understand how you would be trained on 10 plus various strategy paradigms to increase your arsenal to making your trades better and safer. I'm sure that you will have more questions on one of the following: how this can help you in your career, your trades, and your trading businesses, about EPAT program and the potential it holds for you, what are the applicable discounts and payment flexibility. I would encourage you all to help us with your questions and need for information in the form just after the webinar ends. Having said that, I understand that many of you have been in touch with our program counselors and are discussing admission formalities and fees flexibilities. It would be lovely to connect with you guys at a convenient time. You can use the form for the same. So thank you again for being an awesome audience, and we look forward to having you a great association with QuantInsti and EPAT. Thank you.